Well, it's mid October. Want to bring you the latest data here in the Austin metro area. Well, there is one group that's had a particularly good year in the Austin metro area. No, it's not sellers and it's not buyers, it's actually renters. And here's the main reason why. So, really, from COVID on, apartment investment really took off, and Austin has been one of the top markets. But even nationally, this is looking at deliveries, how many new apartment units are coming online year over year. Typically, it was under 400,000 nationally. Well, in the last few years, 500,000, 640, over 500,000 this year. And they're all going to the south. So if we scroll down and check this out, this is the regional breakdown. Half of the units are coming just to the southern states, with key markets like Atlanta, Dallas, and Austin really building a lot of those apartment units. Denver and Phoenix are also top markets. New York City still at the top, but it's a much bigger metro. But the Midwest and Northeast typically are not getting a lot of units. But let's go down and break it down by city. Here's the top 20 US metros for new apartments. Obviously, New York, number one at 30,000. Dallas, number two at almost 29,000. But look at Austin, right there, number three in terms of total units. And we're not nearly as big. You know, New York's got 13, 14 million people. We have two. And so we're adding a lot more stock of housing to our market by building new apartments. I'm going to scroll down, get past this one. This is cities for actually opening or completing and bringing online those units. Austin's killing everybody else. Like, we're adding 15,000 new units that have to be rented to the market this year. So we're not just building them, we're actually, these are the ones coming online, which means we're going to have some next year as well that haven't yet been completed. We have probably passed the peak of construction, but yet we are still adding so many units. And to put that into context, like, what is 15,000? What does that mean? So I want you to think of some of our suburbs. Some of them have 15,000 people or 20,000 people. We're basically building another suburb of empty units and pouring them onto the market on top of what we've already built and on top of everything that we're already trying to rent, everybody's single family house and duplex and condo and everything else. And so all that new has done what to the rental market? Rents are going down. This is why it's been such a good deal for tenants, is when you have that many new units hitting the market, especially in markets like Phoenix and Austin, for example. You have no choice. It's supply and demand. The apartments, especially, they're all kind of nice, class A. They got a swimming pool and parking and the whole thing, maybe a gym. And so anyways, well, they're giving away 1 to 2 months of free rent, or they're giving away discounts to tenants, things like that. Well, if they're low in their rents, well, then it just kind of flows down in a waterfall to the B class apartments and then the C class apartments, and especially the condo market and the duplex market. Even the single family market is impacted by not only all the apartments, but it's impacted by all the sellers who couldn't sell their house or didn't choose to sell, finish selling their house, flip their house into a rental. So we're seeing just a glut of supply. The real question is, how long is that going to last? We're not sure. But if I scroll down to this data, the coastal and Midwest metros, the ones seeing higher rents are markets like New York, Chicago, Minneapolis, San Francisco. A lot of those are land restricted markets too. So they have no choice. You can't really continue to build out. Whereas the ones where we're seeing negative rents are in the high supply metros like Denver, -4%, Austin, -4%, Phoenix, -3.3, Vegas, -2, Dallas. So those markets that can expand, that can build, are the markets that are seeing negative rents. All right. Home sellers, what are they doing right now? Well, right now we are seeing record rates of price reductions. This is a national article from Redfin, but this chart kind of shows it to you better. And I'll see if I can zoom in there a little bit, see if you can see that a little better. But this is the number of listings on the market as a percentage that have done at least one price reduction or price change. And so, if you go back to 2012, it was extremely low. Houses were probably, so this is at the end of the last downturn, houses were probably starting to sell better at that point, and you had less inventory. So you had fewer price reductions. And then, of course, as the decade went on, you got back to, we'll call it normal rates, maybe that 8 to 10% of homes rate. Then we had the pandemic, and you saw the number of homes that needed to reduce their price dropped because they sold so fast. Well, now we're seeing that skyrocket back up. That means typically longer days on market equals more price reductions. And so when you start to see markets, not just ours, but you start to see nationally more and more markets having longer days on market, more supply, you're going to see more price adjustments. So where is Austin right now? We talked about this last week. We are now clearly in the fall market. I think the next 4 to 6 weeks is when we're going to see the last kind of wave of whatever buyers are left in the market. We're going to see them writing their offers if they want to close before the end of the year. Supply is coming down. This is number of listings. However, we are still significantly above where we would be typically, which is about 9,000 homes for sale. We're still sitting at almost 14,000 homes for sale. So we've got 40% more homes than average on the market. The last time we haven't seen homes on the market this many, but the last time we saw homes above 10,000 was back in 2016. So it's been a decade, and now we're well above those numbers. Demand still below normal. Gray is kind of the 10-year normal, but we're pretty neck and neck with last year. And again, we're seeing about, let's call it 2,500 homes a month, just under that selling per month. So when you have 13,000, only 2,500 are selling, kind of gives you an idea of the pace. This is the 10-year appreciation. And obviously, we're kind of rocking steady 5, 3, 2, 9, good appreciation coming into the pandemic. And then of course it took off like a rocket, over 60% appreciation in just a few years. Since then, we've had a pretty sizable correction in Austin. I'd say these numbers aren't going to reflect it, but I'd say typical houses are probably seeing 25%. Price adjustment off the peak. Some segments are getting hit a little harder if they have higher inventory, maybe condos, some of the luxury market. So we're watching all of that to see what happens. Finally, just talking about, what impacts sellers the longer it sits on the market. Two things. Number one, the longer you sit on the market, more often than not, you're going to need to adjust your price to attract the buyers that are in the market to write you offers. So you're going to see the percent off your original price grow as we get longer days on market. Maybe that first price reduction is 2 or 3%, but if you had to do it 3, 4, 5 times, you might get 10% or more off where you started if that house has to sit on the market for 5 or 6 months. And then of course, the longer you sit on the market, the buyers are also going to be a little more aggressive in trying to get a little more off whatever list price you're at, the longer you sit on the market as well. So it's almost like a double whammy. Buyers are going to maybe take a little more off where they settle. Like if you can settle early, maybe you're within 1 or 2% of your list price, but the longer you take to negotiate with that buyer, maybe it's 3, 4, 5% off whatever final price you got to before you got an offer. So again, we're seeing that in the market with the longer days on market. Here's where we are. Again, we just showed that chart. This is just active versus sold listings. The last month of closings, we had 2,571 single family homes. This isn't including condos, townhomes, duplexes, all that stuff. This is just single family homes. We sold about 2,500 single family homes, and we finished September with 14,000. So again, maybe 1 out of 5 sellers typically will get an offer in any given month with that pace of sales. What's that doing to price? We started 2020 at 302,000 as our median home price. Just think 300,000 coming into the pandemic. We were still very affordable. 300,000 was our median home price. Of course, rocketed up to 550, just unsustainable. And so, but since then, yes, we've had a really slog market. We've seen prices come down. They've been coming down for 3.5 years, but at the same time, they're coming down slowly now. And so we've just kind of hovered in this 400 to 450 kind of median home price range now for about 3 years. And it's come down a little bit each year, but I haven't seen the median home price dip below 400,000. So that's what I'll be watching this winter to see. If it does dip below that, then we're continuing to soften. But if it can hold up above 400,000, I think you're seeing Austin start to go sideways, even with all this supply, even with tepid buyer demand. The price is really not the issue. It's just having enough buyers that want to get engaged in this market. And we'll see what impacts that as we head into 2026. Finally, it could be rates. But so far, rates have been holding in that mid to low 6% range. We have had some clients get below 6%, sometimes just catching the right day in the market. And sometimes, you get a point or two buy down to help get that rate below 6%. But we're typically seeing, mid to low sixes on a primary home buyer. Investors, some of them are getting below 7% as well. So rates have been holding well. So if you are a seller right now, look, the fourth quarter has always been challenging, even in good years. This is typically when buyers start to pull out of the market. Sellers as well start to pull out of the market with either they sell or they withdraw or expire. So some of it's just a time game to make sure you can get the right buyers in the door and get that property sold. If you're a buyer, the fourth quarter has typically been a good window to buy because of those reasons. You don't have as many people competing with you. The biggest challenge you have is the inventory will start to shrink over the next 3 months as we get through the New Year holiday. And then you'll start to see new listings come out in higher numbers. Typically, once we get to late July and into February, that's where you'll see the next year start to rocket again. Anyways, hope this information was helpful. You can follow our videos each and every week. Make sure to go to our YouTube channel, click that subscribe button at Ryan Kelly Group. We'd love to have you follow us there. And of course, if you know somebody looking to buy, sell, invest, or finance here in Austin, we'd love the opportunity to chat with you. Anyways, great win in Dallas. Hook 'em, and talk to you next week. Thanks.